Hi everybody, this is Lara with your end of the week video for gold for the trading week ending Friday 19th of July. A really sharp reversal at the end of Friday's session completes a bearish candlestick pattern on the daily chart. It puts the breakout that we had a couple of weeks or so ago in some doubt. Both bullish and bearish Elliott Wave counts remain valid. The bearish case has some support at the end of the week from classic technical analysis. Confidence can be had in it though if price moves below 1346.45. That price point very clearly differentiates a bull and bear scenario. The bullish count now expects upward movement to continue. I have 3 wave counts at the daily chart level and weekly chart level. Let's start with the bearish wave counts first. There is a little support at the end of the week from classic technical analysis for these, but overall the bullish wave count would be favoured. However, the bullish wave count does still have a really big problem in terms of Elliott waves, so I want price to continue to prove to us that it's correct. But if your own analysis prefers a bullish outlook, as it may well do, then follow my bullish wave count. It is still possible that gold could be in a bear market, that it's still within a big 3-step back pattern subdividing as a big zigzag labelled A, B, C. It's possible that B could have been over as a double zigzag at the high for this week. The first zigzag in the double is complete here, labelled primary W. The double is joined by a 3 in the opposite direction labelled X, which subdivides as a double combination. And the second zigzag in the double may be complete 5, 3, 5, labelled primary wave Y. It's managed to move price beyond the end of primary wave W, achieving its purpose of deepening the correction, although not by very much. And the only problem here is the structure of primary wave X. X waves within double zigzags are almost always single zigzags, but they can technically be any Elliott wave corrective structure. There is a maximum number of corrective structures in multiples, and the maximum is 3, and that count refers to W, Y, and if there is one, Z. It does not refer to the joining X waves. They can be any corrective structure. And here, this subdivides very well as a double combination. Zigzag, X, flat correction. But because this is subdividing as a combination and not the much more common single zigzag, that does reduce the probability of this wave count. However, it's still the best looking bearish wave count at this stage. If cycle B is over here, then cycle wave C should have begun. This wave count needs a new low by any amount at any time frame below the confidence point before I will discard the bullish wave count. Within cycle C, no correction may move beyond its start above the invalidation point. At the daily chart level, the low of B, intermediate wave B is here, intermediate C subdivides very well as an impulse, 1, 2, 3, 4, 5. There's another little thing here that indicates this could be the correct wave count, not is, just could be. This is a very short little 5th wave out of a 4th wave triangle, and gold has often surprisingly brief and short 5th waves out of its 4th wave triangles. I've been surprised by that tendency before. This would allow for that tendency to have happened here. Just a little note about this price spike on this daily candlestick. Because the high on this day on the daily chart is really different to the structures we see and the price movement we see on the hourly chart, it is highly suspicious. I think this is another corruption of bar chart data, and I've got a support ticket open with them. They should be getting that fixed really soon. So because I cannot analyse the structure of this at lower time frames, and because they have recently had some problems with their data, which they have then subsequently fixed, I am ignoring that little high there. Otherwise it would invalidate the way I've labelled the triangle. So I am aware of that. This is not invalid labelling. Okay, if cycle wave B is over here, cycle wave C needs to subdivide as a 5-wave structure, either an impulse or an ending diagonal, much more likely to be an impulse. If overlapping suggests it, that's when I consider diagonals. Within the impulse, no second wave correction may move beyond its start. But this wave count now needs a new low below this price point in order to have confidence in it. At the hourly chart level, There could be the first 5-wave structure down nearly complete. I'd label that minor 1, and then I'll be looking for a bounce to begin early next week for minor 2, which may not move beyond the start of minor wave 1. The invalidation point is exactly the same at all time frames for this wave count. This is another bearish wave count, well, bearish for the long term, bullish for the intermediate term. I've published this before. I'm going to publish it again now because now it diverges from my other bearish wave count. This is still seeing cycle wave B as a double zigzag, W, X, Y. Y has a purpose to deepen the correction if W hasn't moved price deep enough, and so far it's achieving that, and it could be incomplete. The structure here of primary wave X is seen as a regular contracting triangle. This has a really good fit. A, B, C, D, E. Remember, X waves can be any Elliott wave corrective structure, including multiples themselves, but they are almost always single zigzags. And so again, this is a problem with this wave count in terms of the most likely structures in terms of Elliott wave. But everything subdivides well. There's no problems in terms of subdivisions. Primary wave Y needs to subdivide as a zigzag. If it's begun here, then A may be a complete impulse. Now it would be expecting a big consolidation, either a quick, sharp pullback or a big time-consuming consolidation for intermediate wave B, which may not move beyond the start of A, below the invalidation point. The target is for primary Y to meet equality in length with primary wave W. At the daily chart level, this low here for primary X is this low. Here's the structure of intermediate A. Now expecting intermediate B. The Fibonacci ratios of intermediate A may be targets, possibly favouring the 0.618 ratio, although it may not get that low. It may only end about the 0.382 Fibonacci ratio, which is very strong support now because it was previously for many years very, very strong resistance. Intermediate B may not move beyond the start of intermediate A. At the weekly chart level, this is the bullish wave count that I have for gold. If you have any type of bullish wave count for gold and you're seeing a major low down here, then the first movement up off the low, the start of the bull market, must be seen in Elliott wave terms as a 5-wave structure. There are only 2 5-wave structures, motive structures, impulses, or diagonals, and this will absolutely not fit and meet rules as a diagonal, and so you have to count it as an impulse. As far as I can tell, the only way to see this as an impulse is 1, 2, 3, 4, 5, and this is the problem which I keep going over. 4 is much more time consuming in terms of time, and it covers a much greater distance in terms of price than its counterpart second wave, which is very, very quick and very, very short in terms of the distance and price it's covered. This gives this upward movement for gold a really strong 3-wave look. Now I can handle disproportionate second and fourth waves, but only when it's the other way around, because gold is a commodity, and commodities quite typically exhibit swift, strong fifth waves. In classic analysis terms, we put that in terms of they exhibit blow-off tops and capitulation spikes fairly readily. In Elliott wave terms, the way we look at that is it's the fifth wave to end a third wave impulse, and sometimes fifth waves to end other waves as well, but usually fifth waves to end third wave impulses are the really strong movement. When commodities do that, they force the fourth wave that comes just after to be more brief and shallow than it would otherwise be, and that gives gold and other commodities impulses 3-wave looks at higher time frames, because the second wave is much more time consuming than its counterpart fourth wave. So this is absolutely fine. This is a normal looking impulse for this market, but this most definitely is not. This is really unusual. It is possible. This meets all Elliott wave rules. It just is a huge variation for this market from its normal behaviour, and for that reason, in terms of Elliott wave, this still has a relatively low probability, but price has broken out from multi-year resistance. This is a very technically significant breakout, and there is a reasonable amount of support now from classic analysis for this bullish wave count. Price will tell us eventually in coming weeks or possibly months which of these wave counts is definitely correct. For now, I'll run them all side by side. If your own personal analysis has a bullish outlook for gold, then this may be the Elliott wave count you choose to follow. If cycle 1 is over here, then cycle 2, it can't be a triangle. Second waves don't subdivide as triangles, but it certainly could be a double zigzag, zigzag, X, expanded flat, 3, 3, 5 for primary Y. So cycle 2 could be over here. Cycle 3 may only subdivide as an impulse. So far it may have 1, 2, and 3 for this idea would probably be incomplete. The target for 3 at primary degree is to equal 1.618 times the length of primary 1 at 1565. Primary 3 may only subdivide as an impulse, 1, 2, 3, 4, and now within the fifth wave. When primary 3 is over and primary 4 arrives, primary 4 may not move into primary wave 1 price territory below this invalidation point. Because this Elliott wave count is done using cash data from bar chart, I will accept absolutely no overlap between primary waves 1 and 4 for cash data. That rule is absolute. A new low by any amount at any time frame, even a fraction of a cent on a tick chart, would see me firmly discard this bullish wave count. Price must remain or must not move below this point. Primary 4 can touch the end of primary 1. The rule is clear. It may not overlap. This is an acceleration channel. Draw it from the end of primary 1 to the last high. Place a parallel copy on the low of primary 2. When primary 3 is complete, if we keep redrawing the channel as such, then it will be Elliott's first technique, and we'll use the lower edge for support for primary 4. The target for cycle 3 is for it to reach 1.618, the length of cycle 1. Let's take a look at this at the daily chart level from the low of primary 2, this point down here. Primary 3 for this wave count should be incomplete. 1, 2, 3, 4, and the fifth wave should be continuing, although the strong reversal at the end of Friday's session puts that in a little bit of doubt, although this is still entirely possible. And again, primary 4 may not move into wave 1 price territory. This price point to differentiate my bullish and bearish wave counts is really important. At the hourly chart level, the start of intermediate wave 5 could have an impulse for minor wave 1, a time-consuming second wave, a very quick fourth wave. Again, that's typical behaviour of gold, and so I will allow for this in this wave count, even though it's not happened for a third wave. It's happened for a first wave. That's still okay. Minor wave 2 looks like an incomplete double zigzag, W, X, Y, subdividing 5, 3, 5, maybe to end closer to the 0.618 Fibonacci ratio. Here I've extended the trend lines out from the triangle of intermediate wave 4. This upper reach of the trend line may offer some support. Look out to see how price behaves early on Monday when markets open if it gets down there. If it slices quickly through, then that would be a slight concern for this wave count. Minor 2 may not move beyond the start of 1 below the invalidation point. Let's have a look and see how the week closed for gold. Last week we had that really strong upward breakout above, this is monthly. Last month we had a strong upward breakout above multi-year resistance. That's why I'm showing you the monthly chart every day, because this breakout is so technically significant. When it happened, I said to exercise a little bit of patience and look out for price to curve around and test support, which was previous resistance. That's pretty much what we've got. The test was not quite as low as I had expected, but that's exactly what's happening. The breakout had support from volume, and so we should have confidence in it. Price remains above support. That's the bottom line. While price remains above support, a bullish outlook overall in that bullish Elliott wave count should be the dominant view. On balance volume has a very wide range, not at resistance or support. It is exhibiting some bearish divergence though here at the monthly chart level. Price is making new highs, but on balance volume hasn't managed to make corresponding highs, so there is a little bit of weakness there. ATR has been declining for a long time as price has been consolidating for years now We don't have enough data yet to show that it's showing an increase. RSI is neutral, room for price to rise or fall. Stochastics, possibly entering overbought price territory, but overall in neutral territory. At the weekly chart level, this week there's a slight concern with some long upper wicks on the weekly chart. And between those highs, there is some bearish divergence between price and stochastics, and double bearish divergence while stochastics is overbought between price and stochastics. So there is some weakness here within upward movement. The bearish wicks really are a reasonable cause for concern. However, the bottom line again is that price remains above support. That upward breakout is still intact. The cause for concern could be resolved most certainly by a more time-consuming and deeper pullback to better test support. This is a pretty brief and really shallow test. Perhaps we're going to get a more decent test. Only if price closes back well within that consolidation zone and there is some strength in downward movement would I then say that the breakout may have been false. But with the data that we have in hand today with gold, there has been a highly technically significant upward breakout. We may not have had the test of support complete. There is a little bit of weakness here. We may be about to get a more time-consuming and deeper pullback here. Volume is supporting upward movement though for Friday, for the last week, a higher high, a higher low, and some support from volume, although overall a little bit of a decline from the week where we saw the breakout. On balance, volume has bounced up from support. There is no short-term divergence here at the daily chart level between on balance volume and price, but there is at the weekly chart level and monthly chart level. ADX is increasing at this time frame. An upward trend is still indicated, and it has strength from rising ATR that supports the bullish wave count. And MACD is full bull bullish. What about the short-term picture? And this is a bit concerning. For Friday's session, a higher high and a higher low, but a bearish engulfing candlestick pattern. The candlestick is red and it's closed below the real body, which is a doji of the prior candlestick. This is still a fairly strong bearish candlestick pattern, and here there is clearer bearish divergence between price and RSI, and it's quite strong, and price and stochastics. That's happening while ADX indicated that this upward trend reached very extreme. Now we have a bearish candlestick reversal pattern, and the engulfing pattern is the strongest candlestick reversal pattern. It has some support from volume actively pushing price lower on Friday, and it comes with divergence between price and RSI. In conjunction, those signals all together either put doubt on the upward breakout or tell us that we're going to have a more time-consuming pullback and consolidation, that the upward trend is not quite yet ready to resume. We may need some more pullback or consolidation to better test support, to bring conditions down from extreme, to allow room for the next swing of the upward trend to continue. ADX is again increasing, telling us that there is still an upward trend, but it is still very extreme. ATR showing a strong increase as price rises. There is strength in that upward movement. MACD gave us a bearish crossover. Price has been consolidating. MACD remains bearish. That's all from me this week with your gold analysis. I hope all of our members are having an awesome weekend.